Great.
Yeah.
All right, well, I guess we'll get things kicked off. So first off, thank you all for joining us today on this fine Wednesday. We are introducing a StockSnips webinar series. So the first one that we will be sharing with you all is how to leverage AI in investing strategies to achieve alpha. We will be joined by our host today, Ravi Koka, founder and CEO of StockSnips, and also Satya Pradhuman, CEO and Director of Research at Cirrus Research. So what will we be covering today? So we are going to be covering market trends and how the introduction of AI could benefit investors. We will also be looking at how does combining AI and machine learning dynamically rank stocks into alpha achieving portfolio models. We will also dive into a quick look at how can the use of AI provide a new quant lens into your investment process, and also deliver what type of news is driving portfolios investments. Lastly, we'll dive into some sentiment signals that StockSnips has introduced into the investing world, and share some insights how that will compare with traditional factors and fundamentals. So let's kick things off. And Ravi, if you'd like to give us an overview of some of the investing trends that you've seen over the years and where we're at in today's environment.
Good morning, everyone, and welcome to the StockSnips webinar series. In the last decade, we've seen a massive shift from active investing into passive investing. More than 50% of the $100 trillion are in index funds and ETFs. This has obviously, this is something that was heralded by people like the Vanguard Fund, and now, of course, there's lots and lots of ETFs. So it's become a major challenge. So the trend for active investment management has been under pressure. The introduction of robo-advisors was another innovation, in the last decade, and you've seen these are fairly simple in terms of what they do, but they did again take a market share away from the traditional advisor space, and a lot of the other traditional advisors have also moved into the robo-advisor space, and it's really a combination of robo-advisors and handing off to a human advisor, which is really the right balance. And most recently, in the last 3 or 4 years, we're beginning to see the extensive use of AI being artificial intelligence set of algorithms. It was initially, you've seen that in the use of trading algorithms, and now we're also beginning to see in portfolio selection, portfolio rebalancing, we're beginning to see companies and a lot of research and obviously firms offering AI-based portfolios. What has changed? What is it that has made AI feasible? And one of the things I've seen is this tremendous growth of data volumes, what is called big data. In fact, as one of the statistics is that 90% of the world's data was created in the last few years. So how do you deal with this exponential growth? This is where computers and AI provide you an edge. Human beings cannot process large amounts of data, and more importantly, there's unstructured data, not just structured data, continuous news, online news, podcasts, blogs. There's a lot of news that's continuously driving the markets. And the other thing we've seen is that market emotions and investor sentiment have drive company valuations and not just fundamentals. The other statistic is that we've seen in the last decade that 80% of the mutual funds and wealth managers are underperforming the passive index. So the whole modern portfolio theory and passive investing is really set a high bar for active managers. The other interesting thing we saw especially in 2020, 2021, is the rise of meme stocks, the rise of retail forums like the Reddit Wall Street Bets, and this is again introduced another major factor in in terms of both opportunity and risk, and a lot of the active portfolio managers have been starting to look at how do we deal with all of this. So this is where big data, AI, these are the new tools required for active managers to keep up with the high bars set by passive investing. And I think we've seen they're beginning to deliver a lot of assistance and will make an impact on the way active management of portfolios is managed going forward.
Perfect. Thanks for that insight there, Ravi. And I guess, Satya, I'll pass over to you now. If you have any insights also to add on what Ravi just said, maybe how AI can help in some broader market trends.
Yeah, sure. First of all, thank you so much for inviting us to speak in this forum. I'm a big fan of Ravi and StockSnips. I think to get you a sense of how we got involved over the last few years, I found that Ravi and I connected, and we started talking about some of his data. And as being, research analysts, strategists, and quants in the investment space, we tend to become fairly skeptical of people claiming that there's good data, because we've played with a lot, and it's a lot of backtest work. And then when you put it in the real world, it's like, whoa, not exactly right. My experience with Ravi and his firm is that you guys have been terribly open about your data, and you allowed us to test it, fairly broadly. The background that you talk about, Ravi, I think if I go back one chapter before this, in let's say the 60s and the 70s of investing, this idea of sentiment has always been there. It's just evolving. And I think you guys are a natural extent of what's been underway for decades, which is it started with a single person being really smart, digging into information and saying something about what they think. That then tumbled into decades of where the industry started to form. You started getting hundreds of analysts and expert voices, which then became quantified by a measure of consensus, right? And so the early form of what you're doing was basically listening to a bunch of experts with their forecast combined into a number, projected out. And so many of the quantitative structures that we deal with, we've built, tend to look at that forum. And our motivation for this is to really look ahead and say, wait a second, will Wall Street continue to have all these analysts, and will they all be available in a nice packaged way? And how much do we trust it? And so we've always got to be experimenting and investigating. And what I thought was interesting was with your work, it does lend itself nicely into the extension of modeling sentiment, and in some ways might be a lot smarter. We'll talk a little bit down the line about the sort of, how it fits into constructing a portfolio and how we can make it work. So we've got some good experience with that, and I'd love to share it. As we jump into this period, you also talked a little bit about index investing. And I think if we look at the overall tape in the last few weeks, we understand there is a downside to buying the market, which is sometimes the markets go down. And if you look at the next slide, and so this starts to tackle this idea of a diversified portfolio in some ways. We're calling it a barbell strategy. And the house view recently has been to really look for better earnings visibility in this environment where the environment is less than certain. The profit cycle is likely peaking and rolling over. We've got liquidity being siphoned out of the market now. And guess what? The benchmarks aren't going to look great. So this idea of active versus passive is going to become, again, a real debate because the world just got more difficult. I guess if you've got like a central bank that's willing to pour billions into the system, make it easier for people to buy risk assets, maybe we don't have to be so smart about stock picking. That said, if some of that spigot closes or it starts to reverse, all of a sudden these elements we're talking about in this meeting, portfolio construction, all of these things, valuations, they start to matter. And so our barbell strategy here is to respect the fact that with one single moment with the Ukraine invasion, what we ended up getting was a radical shift in energy policies for Europe. I'm not sure anything happening in Ukraine is going to change that now. That definitely has an impact on commodity prices, inflation, again. And then, so what we think you're living with is in a world of, you've got to have some gritty, sort of deep cyclical exposures, and at the same time, bulletproof balance sheets, high earnings visibility, earnings-driven market, and we compete for the next chapter. So I think this is a grittier, tougher environment, and I think active is back. It is no longer an easy trade to just buy the index. So modeling expectations with the sentiment data becomes terribly important. The next slide kind of gives you a hint into what has caused the shakeup in the last 3 weeks. Why are we suddenly scared? And what I can relate this to is the fact that this break in the market trends, where the vaccine surfaced and investors started to look outside of lockdown stocks. As that occurred, it signified the peak in speculative innovation shares. So the purple line here at the top panel represents the performance, and I don't want to pick on any fund, but it was such a successful fund in really carrying the banner for innovation. We've used it, and it's one of the ARC funds. And what that shows is that really since the fall of 2020, we began to see the peak in innovation shares. So what we're seeing in our research is that the break in speculation started about 18 months ago. The shocking thing is no one noticed, because it was just that one fund in the corner, when really what was going on was all these small cap aggressive growth names were getting shattered. And so I thought it was a terribly nice correction until about 3 weeks ago. So what the blue line at the top represents, though, is a collection of the extended FANG shares. And what we're getting at is now what's happened is there is some contagion where this breakdown in innovation, or the need for risk assets, is starting to back away, so much so that it's going to hit the sacred cows. And what I mean by that, it's going to hit the FANG names, which are darling stocks, companies we all love. And so I think this is a new chapter where fundamentals matter, active becomes relevant again, valuations are going to matter, and importantly, really focused on where earnings are going to break or where expectations are fading. That stuff is going to be worth a lot here.
Thank you, Satya. Very interesting insights there. And, I did listen to you reference, obviously, the sentiment signals that here at StockSnips we've developed. So I guess, Ravi, I'm going to pass over to you. And firstly, if you can share with our audience, this term of AI it's a very big buzzword now. If you could help us demystify what AI is and some machine learning insights, and then dive into our sentiment signals.
Sure. AI, artificial intelligence, this is not new. This is, the father of AI was McCarthy, who coined the term artificial intelligence. And his dream was that, was taking it forward from where Turing had left it. Can machines think? And obviously there were limitations of what machines could do. Can machines, mimic human intelligence? So really what happened was, there was the cold winter of artificial intelligence, when machines were not powerful enough to realize some of the ideas that McCarthy and other fathers of AI like Minsky put forward. And AI is a collection of various things that human beings, intelligence that human beings possess. For example, recognition, facial recognition, speech, robotics, the ability to move and to pick objects and so on. So all of those are basically things that human beings do, and the big question was, can computers or machines do this? And we've seen, and really what happened was that the As machines got faster and more data was available, that's what is brought us to where we are today, where you've seen, for example, whether it's Siri or Google Voice or Alexa, speech recognition, which was considered to be a problem that was difficult to solve, is it's 99% accurate. Facial recognition, you've seen things like Google Photos and so on. So there's been amazing progress. And the other aspect of AI, another branch of AI is machine learning. Machine learning is a set of algorithms that are able to recognize patterns. They're used for classification, they're used for prediction, and there's been a tremendous amount of progress based on some very solid statistical models that have been tried and built. And that's what really made the difference, both for facial recognition and for speech recognition. And now the question now is, can you use this technology in the investing world? In this, can it recognize patterns in the movement of stock prices or in the construction of portfolios? And this is where what StockSnips has done research over the last 5 years is in the area of use of natural language processing. Natural language processing is for a machine to read textual information, be it an article, be it a podcast, or whatever the source is. The ability to read text, break that text down into the actual composition of that article, sentences, parts of speech. It's literally like what a human being would do, right? If you read an article, you have to understand, what is the article about, what topics are being referenced, what entities are being referenced, who is saying what about the object. And so there's a lot of subject-object analysis. All of that is now feasible with what is called natural language processing. And the accuracy has reached, with these what is called deep learning neural networks, you're looking at 95% accuracy, pretty much close to human intelligence. What that means is if a machine reads an article and comes up with certain analysis or interpretation versus a human, these two are it'll be very difficult to figure out whether it's a machine or a human. So there's a tremendous amount of progress. So combination of AI techniques such as classification, natural language processing, as well as machine learning algorithms that have already been used in trading is what we're now looking at use in deriving sentiment from news stories, which we believe drives valuations in addition to fundamentals. And what we have done is to create a database of 5,000 US equities, and we now have close to 6 years of history. And we have some unique methods of modeling the sentiment and how sentiment decays. We call that the message decay model. MSDX is what we call that. What we have done, as I said, was we take the news stories from roughly 20 plus sources, including the company's SEC filings, news from sources like Associated Press, Reuters, etc., and also opinions expressed in Motley Fool, Barron's, Seeking Alpha, etc. These are very detailed opinions about a particular stock. So what we're getting as an input is we're getting interpretations of what's going to happen if interest rate hikes is hiked, what happened, impact of the Ukraine war. That gets translated into impact on specific US equities. And that's what we're capturing in this signal. And all of that goes through a pipeline of natural language processing algorithms, a machine learning algorithm for classification, and what comes out is a sentiment score. And that sentiment score represents the collective view of all of the opinions expressed in these 20 sources that we are continuously monitoring. And that's what we're calling it, the StockSnips sentiment signal. It's a financial media sentiment signal we do this for ESG also. So we're transforming large amounts of unstructured text into a single sentiment score that becomes now a time series, which is what Satya and group have extensively tested. So now you have a new set of time series data available on a daily basis. You can now combine this with fundamental data and price data and use this as an alternative factor in portfolio construction.
Great stuff. And I think, that leads us nicely into some anecdotal examples here, Ravi. So to start with, this is more of a broader market example. If you could demonstrate to our audience how our sentiment signal compares.
Yeah, this is an example. If you see the chart at the bottom, the dotted line is our aggregated market sentiment for the 5,000 US equities that we cover. And we are plotting that against the S&P 500. And you can see that in May 2019, you see the dip in sentiment and followed by the dip in the S&P price. And subsequently in February 2020, you saw that sentiment kind of, went down before the price went down. And you can see that that was the impact of the COVID, the onset of COVID. On the top line, on the top chart, you see the VIX, which is another, that's a macro, it's called the fear gauge. It's basically a market sentiment example. The VIX index is very widely used. And you can see the dotted line is the VIX index. It's a little bit flat throughout compared to our signal. So, and we therefore believe that our signal captures more of the, on an ongoing basis, it captures some of the changes in the market sentiment. The VIX is used for tail risk hedging, and it's you can see that happened in March 2020 when the VIX went up to 80 and the market went down more than 30%. Another example at the individual company level, this is for Tesla. You can see Tesla sentiment rose. The red line is the 7-day moving average of sentiment. And you can see that it crossed the 50-day, the green line, which is a 50-day. And basically that is an indicator. It's anecdotally, we've seen this pattern with many stocks, and we've done studies to confirm that sentiment is a lead indicator of price change. You can see here the white line that represents the price started to rise after the sentiment went up, and it peaked on the 4th of November. So it can be leveraged. This is how you can leverage the sentiment signal. And if you do this across thousands of stocks and use that as another factor for picking stocks, then there's a potential for alpha.
Great stuff. And I guess leading over to you, Satya, can you share with us, using the sentiment signals, how you've been able to use this in your portfolio construction methods? Sure.
So I'll give you a little bit of background, and this ties back to this idea of sentiment and trying to find better measures of it. Another popular measure of sentiment, I think just about every portfolio manager is looking at or using, tends also to be price trends. And this is sort of a neat, like we really stumbled into this finding. What we thought we were going after was to see if the big data AI sentiment signal really was a superior form of consensus estimates, right? So we're always on the hunt for something that's going to be better than that fundamental sentiment. And the other sentiment that's just as popular is relative strength or price trends. And what we found was that the trending factors were generally, they were correlated to some of this big data, but their sort of risk return profiles were indeed inferior. So now what you're looking at here is just a very simple cut of the StockSnips data. And we believe strongly in isolating larger companies from smaller companies, just because the risk profiles of a big company is radically different from a small company. So to throw all the data in and then run a simple bin test, I think you're going to fall short of what the real risks that are getting covered up are. So in order to separate some of that real, sort of noise in the system, we separated the bins into big companies and smaller companies. And so what you've got here are three asset classes that we tend to focus on: large, mid, and small. And these echo the S&P 500, the mid cap, the Russell mid cap, and the small cap index, or the Russell 2000. And what you'll see, the dotted line is just the market trend. And I'm sure we should have put more benchmarks there, but you wouldn't have been able to read the chart. But what it's telling you is that the outperformance of a simple sort of annual or quarterly rebalance, monthly and quarterly rebalancing of this data from Ravi lends itself nicely into a strong performance trend. All three of the asset classes, the bins, which are basically, I believe they're top deciles, they may be top quintiles. I forget now, it was a few years back we did the study, but what it's showing is that they nicely outperform the benchmark. And so what that told us right away is, okay, we've got something interesting here and robust. The other thing that came across, I think, Ravi, from your prior slides is the one thing that caught my ear was that your data is not just being scraped from the web. You're getting real sources. So, the old adage of garbage in, garbage out holds. And because your sourcing is actually fairly robust places, we think that whatever's coming out of that is probably better. So bottom line, I think the simple cuts of this data is saying that you've got yourself that if we rebalance it on a less frequent period, because most of the institutions we're covering that let's say are dealing in mid and smaller firms, for instance, they can't afford to trade every day. You'll be your broker's best friend. So what this, if you go to the next slide now, what you'll see is sort of what I was getting at earlier, which is a look at two different measures of sentiment, more traditional that goes back in history, and the new sentiment data from StockSnips. And what you'll find is that the traditional earnings revision model is interesting. The relative strength model is interesting. What's curious though is that the correlations between the StockSnips data and the relative strength data are the highest, but importantly, the returns and the Sharpe ratios for the sentiment data are superior. So we think we have something here, and that allowed us to move ahead to basically embed this signal into portfolio construction. So we feel that a portfolio is as good as its components, and we're a strong believer in best of breed. So what you will not find Cirrus working on will be the wonderful 50-factor model. The world is too correlated, and as a result, you need to do the extra lift to understand where there are unique signals coming from that are also robust. Once we combine those elements, we end up getting to a better product design. And so we actually did something fairly radical. We ran a multi-factor portfolio, and we actually dropped traditional relative strength. So we're not using trending. And we replaced it with the sentiment data, and we ended up getting a much better result. So I think we're onto something, and I still feel like we're in the early days, but some of these out of sample portfolio results, in fact, there's some seed capital that Ravi and his team has really sort of seeded and followed. Some of these results are turning out to be fairly consistent with some of the backtest results.
Amazing. Thank you, Satya. And Ravi, I know you've done some further validation with CMU, finding that the bifactor model optimizes alpha creation. Can you walk us through this chart here just for some extra insight?
Yeah, in the investing world, alpha is the holy grail, right? So you want to be absolutely sure that Satya did their studies, and we wanted also another independent study that was done by Carnegie Mellon PhD student and a professor. We gave them the data, and it was an independent study. And the idea was, can you put some rigor into measuring the alpha? So what they did was they ran a portfolio strategy based on the Russell 1000, picking the top 5% and the bottom long shot, and basically did daily trading, and then measured the returns, measured the portfolio returns, which was being basically daily rebalanced using the sentiment data. And then they did a regression. They regressed against the PAMA French factors, which is the 5-factor growth, value, quality, size, momentum. And then the regression, the idea, the goal was to see, is the sentiment, the excess return over market return, where is that coming from? And that study showed that the alpha attributable, not the alpha or the excess return over market return, attributable to our signal. As you can see, for small and mid cap, it was 15.81% for using sentiment only. And using another derivative of sentiment, which is sentiment momentum, which is the change in sentiment, the large cap responded better to that, and that was 6.16%. The large cap did not, interestingly, respond to sentiment. This is to do with the information flow, this herding with large stocks. Everybody gets the information at the same time, and these are very heavily traded. So the sentiment momentum is what gave us the extra return. Ultimately, it's the bifactor model that was more suitable for large cap. For small cap, it didn't matter, just sentiment alone. The bifactor and the single factor delivered the same amount of excess return. So this is another validation study. There are other studies. So basically, over the last few years, we have done extensive studies to validate our signal. And of course, portfolio construction, that's a different problem to solve. We've proven that there is alpha to be leveraged in our signal. How do you build optimized portfolios? There are other issues that come up in portfolio construction, such as things like tax, implication of taxes, other costs, other trading costs, and things like that. So there's more to it, and that's where I think we are now moving towards building portfolios and testing them out of sample.
Awesome. And I guess, to kind of wrap things up, just a few takeaways on both ends there. If you could share really what you see as the future of investing. Does AI hold a place in the investing sphere, specifically for active managers? If you have any insights to share with us.
As you know, I'll start, and then Satya, feel free to comment. What I've seen, and there's been a lot of academic research papers that have come out, and what we've seen is that AI, it's still early days. As Satya said, these are early days. There is opportunity, and there is some intriguing insights that we are gaining, but there's a lot more work to do, especially with portfolio construction. So at StockSnips, we have been testing deep learning networks, not for sentiment, deriving sentiment, but actually for constructing an optimal portfolio. And we've had some mixed results, and now we're actually moving on to the biggest problem with the stock market is, as you all know, is in time series forecasting, the non-stationarity of data is what gets you. What works in a certain regime does not work in another regime. And Satya has been around too, and he'll comment on that, because the biggest problem is, growth gives into quality, the sector rotations. So does your portfolio, can it adapt? Can you have adaptive models that can adapt to these changing regimes? That's a tough problem. But AI, the machine learning and AI, we believe can solve that problem. We've got some early results. I'll be able to share that in another webinar, but we are now building a model that is more, continuously tracks some of the market factors and tries to adapt to these changing factors. And we'll be sharing those results as we make progress. Satya, your comments?
Ravi, I mean, I think we're trying to do a really, really hard thing here, which is to model, randomness. It's not just the supply chain crisis that's kind of booting up inflation, but then out of the blue, there's an invasion in Ukraine that happens to change the course of oil strategies. And then also, by the way, that place is also the breadbasket of Europe. What does that do to commodity prices, et cetera, et cetera? So this sort of event-driven moment is the stuff that beats up every portfolio manager. Just when you think you have your framework, I framed out the year, I'm ready, I'm trading, and then along comes these curveballs. And then the other piece that is just humbling is just the human beast. We're just not necessarily perfectly rational creatures. And so, I have a Tesla, and I love the Tesla. And I drive it, and part of me is getting used to and more confident being in that car. But I'm nervous because I know deep down in my heart, the hardest part of coding is to get these machines to work with human beings. If we were all working on them, we're all driving Teslas, I would be incredibly confident. So I think the most complicated thing right now is this short window coding, human beings interfacing with machines. And in the similar light with portfolios, I think there's a lot of really neat stuff here that we should be all, as researchers and portfolio managers, looking to. There's an efficiency, a thoroughness that the human being just can't absorb quickly. And so I think we're on the right track. I think there's going to be some fits and starts, but like any really wonderful tool, it takes some real lift. So we're excited. I think some of the early stuff you've shown, Ravi, says you're on the right track. And I look forward to the ongoing chapters.
Awesome. Well, Satya, Ravi, thank you so much for that wealth of knowledge shared from decades of experience. Definitely insightful. And I'll be leaving contact information below in the comments. So any questions that do stem from this webinar, feel free to reach out directly.
Great.
Perfect. Thanks, guys. Take care.
Thanks, Rebecca. Thanks, Ravi.
Thank you.